Hey guys, welcome back to another episode. This is one of the most accurate trading strategies you can use in any market and at any time frame. Even though this strategy is highly accurate, it doesn't mean it's difficult for beginner traders to master. This high accuracy strategy is very straightforward if you're willing to apply its trading rules with discipline. Because this strategy follows market trends, it automatically comes with a high probability of winning, and its profitability is almost always greater than the risk associated with each of our transactions. So, what do you need for this strategy? You only need three indicators: the exponential moving average or EMA, the relative strength index or RSI, and the stochastic oscillator. If you've been watching other videos on the Trader DNA channel, you probably already understand why it's best to use the 200 period EMA instead of other settings like 100, 50, or other numbers. In this video, I want to emphasize that the 200 period EMA is widely used by institutional traders in the forex, stocks, and cryptocurrencies markets. In general, if the price remains above the 200 period EMA line, the market is considered bullish. And if the price falls below the 200 period EMA line, the market is seen as bearish. Because the 200 period EMA is the most popular EMA setting used in the forex, stocks, and cryptocurrencies markets, the signals it generates are automatically among the most accurate EMA signals. The second indicator is the 14 period RSI. In this strategy, the 14 period RSI serves as a momentum indicator. It helps us determine whether price movements are strong enough to continue the main trend, as indicated by the 200 period EMA, or if they are not strong enough, and it's still too early for significant further movement. We do this by using the 50 level line on the RSI indicator. If the RSI line points downward and crosses below the 50 level, it suggests a bearish trend. Conversely, if the RSI line points upward and crosses above the 50 level, it suggests a bullish trend. Why use a period of 14? The answer is that 14 is the default period for the RSI indicator. Most bankers and large traders typically use a period of 14 when working with the RSI indicator. Therefore, you can see that the 50 level on the 14 period RSI works quite accurately. These are the basic conditions to be met in this trading strategy. While the RSI indicator conditions I've explained provide accurate signals, we still need specific price action conditions to enhance the probability of success. So, if you're working with a substantial amount of capital, you can rely on this strategy. The second indicator is the 1463 stochastic oscillator. In this strategy, we use the stochastic oscillator to identify price increases that reach overbought conditions and price decreases that reach oversold conditions. By considering these overbought and oversold market conditions, we always enter the market with a very high chance of gaining significant returns compared to the risk associated with each of our positions. From the explanation of these three indicator rules, you can surely anticipate that this trading strategy is powerful and can provide you with high returns if you are disciplined and consistent in following all the trading rules that I will explain step by step shortly. Trading strategy. The first step in this strategy is to assess the price position based on the 200 period EMA line. If the price is moving above the 200 period EMA line, traders should assume that the market is in a bullish condition, and we should focus on finding the most profitable and high probability buy signals. Conversely, if the price is moving below the 200 EMA line, traders should assume that the market is in a bearish condition, and we should concentrate on identifying the most profitable and high probability sell signals. Once you've identified the main market trend based on the price movement relative to the 200 period EMA, the next step for a trader is to wait for a significant price correction. There are two conditions for a market correction to be considered significant. First, the correction should approach the 200 period EMA line. If, during the correction, the price doesn't get close enough to the 200 period EMA line, then it's not a significant correction, and it's best to ignore it. However, if the correction trend successfully gets near the 200 period EMA line, it means you have a special opportunity to enter the market and potentially gain significant profits. To do this, you need to proceed to the next step. Second, the correction trend should reach an overbought or oversold condition. As I mentioned earlier, when the price is in an oversold or overbought condition, there's a high likelihood of a substantial price reversal. After following all of my explanations, you should now be feeling more confident that everything you need to secure the best prices is within your grasp. The best time to enter the market. This marks a crucial difference between pro traders and amateur traders, the ability to pinpoint the best time to enter the market. In reality, not all traders are privy to this optimal entry time. In my view, once you grasp this technique, your trading accuracy will see a significant boost. So, when is the best time to open a position? The answer lies in when the 14-period RSI crosses the level 50 in alignment with the main trend. This means that if the main trend is bullish, the RSI line crosses from below 50 to above it. Conversely, if the main trend is bearish, the RSI line crosses from above 50 to below it. When the RSI line successfully crosses the 50 level, go ahead and open a position on the next candle. Also, remember to set a stop loss as a safety net in case the price reverses against you. The ideal stop loss should be either above the nearest swing high or below the nearest swing low. To enhance accuracy, traders can consider trendline breaks. As seen in this chart, you can observe a trendline break occurring before the RSI line crosses the level 50. This is an example of a highly profitable trading setup. Here's an example of trading in a bearish trend. As you can see in this chart, the price is below the 200 EMA line, indicating a bearish market trend. The next step is to wait for a significant market correction, one that brings the price close to the 200-period EMA line. The next confirmation is that the market should be in an overbought condition, as indicated by the stochastic oscillator, above the level of 80. If these two conditions are met, it signifies a significant market correction. This means that if the market starts to continue its bearish trend, the trader can profit greatly with relatively low risk. So, when is the best time to open a sell position? The optimal time to open a sell position is when the 14-period RSI line crosses below the level of 50. After the crossover, the trader can initiate a sell position on the following candle. Additional confirmation can be sought through a trendline break, where the trader ensures a trendline break on the chart before entering the market. Then, establish a stop loss at the nearest swing high to secure the transaction in case of a movement against your trade. Next, as you can see on this chart, the price is above the 200 EMA line, indicating a bullish market trend. The next step is to wait for a significant market correction, one that brings the price close to the 200-period EMA line. The next confirmation is that the market should be in an oversold condition, as indicated by the stochastic oscillator being below 20. If these two conditions are met, it means the market is undergoing a significant correction, which, in turn, implies that when the market begins to resume its bullish trend, traders stand to make substantial profits with relatively low risk. As I mentioned earlier, the best time to open a buy position is when the 14-period RSI line crosses above the 50 level. After the crossover occurs, traders can open a buy position on the next candle. Additional confirmation can be obtained through a trendline break. Traders should ensure that a trendline break occurs on the chart before entering the market. Then, set a stop loss at the nearest swing low or below the 200 EMA line to safeguard the transaction in case of a move against your trade direction. From these three examples, I'm confident that you can now understand this special strategy and implement it effectively. Since the indicators used are primary indicators, you can certainly apply this trading strategy on any trading platform you use. Or, if you want to use the exact same settings as I used in this video, you can download the trading system in the description section. I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.